Good afternoon. My name is Ben Larkin and I chair Albion Enterprise VCT PLC. It's my absolute pleasure to welcome you to the company's AGM. Alongside me today, although in a separate room, are my fellow directors, Christopher Burrows, Roger Whitlock, Pippa Latham and Lord O'Shaughnessy. Lord O'Shaughnessy was my fellow director on the development board and has now joined me as on the board of Enterprise. Also present today is Will Fraser-Allen, Managing Partner of Albion Capital, of course the company's investment manager. He will shortly be giving a presentation on the results of the company for the year ended 31st of March 2025, and after that will join me for a question and answer session. Before I move on to the formal business, I would like to say a few words on the merger, which came into force on the 19th of December 2024, following approval by the respective shareholders at their general meetings in December. There was a lot of hard work involved in that merger. It's gone really smoothly and successfully, and I think that's a great tribute to the team who pushed forward and executed on that merger. It's already bearing fruit in relation to reduced costs for the shareholders. There's, of course, the simplified fee structure, and there is economies of scale and reduced administration through holding the investments in one VCT. I very much look forward to working with my fellow directors on the Enterprise board to bring further success to the company. Moving on to the formal business, the quorum for the AGM is 2 members entitled to vote in person or by proxy. I can confirm this has been met, and therefore I declare this AGM open. The notice of the meeting has been in your hands for the statutory period, so I will take the notice as read. To maximise engagement with as many shareholders as possible, the board have again arranged for the Lumi team to broadcast this year's AGM using its online platform. And that, of course, enables members to interact fully with the AGM and including taking part in the Q&A session at the end of the meeting. Before I hand over to Will for his presentation, I would like to explain how the voting process will work. But first, let me state that if you have already submitted a proxy vote to the registrar, you don't need to vote again unless you wish to change your vote. The resolutions will be voted on by way of a poll. The votes received under this process will be added to the proxy votes that have already been received and verified by your independent registrar, Computershare. Once I declare the poll open on the Lumi platform, a list of resolutions will automatically appear on your screen. Please select the option that corresponds with how you want to vote, and the option will change colour, and a confirmation message will appear to indicate that your vote has been cast and received. To vote on all resolutions displayed, select the Vote All option at the top of the screen. If you do want to change your vote, you have the option to reselect your choice. Should you have any questions on the voting procedure, please send them through the platform and someone in the Albion team will respond promptly. Thank you. I now declare the poll open. And following the manager's presentation, the directors and the manager will take questions from members on the company's financial results and proposed AGM resolutions. I'd like to thank the members who've already submitted their questions and queries through to the chairman's email address. If you wish to ask questions, please select the messaging icon from within the navigation bar and type your question at the top of the screen. Click on the arrow icon to the right of the text box to submit your question. Please do so as soon as possible so that it reaches us ahead of that section of the meeting. I will now hand over to Will for his presentation.
Brilliant. Ben, thank you very much indeed. A big welcome to all the shareholders who have joined us today. We very much appreciate the time you're giving us, and I'm looking forward to telling you all about the activities of Albion Enterprise VCT for the year ending 31 March 2005. So if we move to the next slide, and just giving you a sort of very, very broad background, and you'll all be very familiar with the world that we live in at the moment. And it's a world where, of complications, whether that's macroeconomic or geopolitical. We've got wars raging, we've got continued inflation, and we continue to have raised interest rates, but they are beginning to fall across the globe. The UK has a number of things to think about, not least of which a budget that we're all waiting to see what the impact of that will be on businesses. Having said all that, we are a venture capital investor. We invest in highly entrepreneurial management teams who are looking to build new technology and business models around that technology. They are very resilient, and they thrive in whatever the economic environment is. And I will, through this presentation, give you an update on a number of our investee companies and some thoughts on the prospects for the fund. It was a busy year, and Ben has alluded to the merger. I'll give you a little bit more detail on that in terms of some of the numbers to back up that very helpful introduction that you've already had. And then I'll also be able to talk you through what has been a very positive year for the company in terms of investment performance and increase in shareholder value. So let's move to the next slide and talk about the mergers in a little bit more detail. So across the Albion stable, we originally had 6 VCTs. The objective was to simplify that, to create larger VCTs, and that was achieved by going from 6 to 3, very much driven by the respective portfolios of the companies that merged with each other to try and create to achieve, to the extent possible, similarity between the portfolios post merger. The objective was to reduce costs, and that is coming through now, which is good news. But it was also to make the Albion stable a simpler proposition for investors, and particularly standardizing the fee structure that we had in terms of management fee, administration fee, and performance incentive fees. And the benefit that has been commented on by a number of our shareholders who previously held a number of our VCTs, that it has simplified their lives, having fewer holdings in fewer companies. So if I move to the next slide, it's worth looking at the sort of numbers here, because a key part of merger is to create larger vehicles that can benefit from those cost of sales. So this is a very sort of simple table just to show you how the aggregation of Albion Enterprise and Albion Development effectively doubled the size of the business, the size of the companies, which were both 131 million and post simple arithmetic is now 262 million. So a significantly bigger company and a decent sized VCT. So let's move on now to talk more about the results for the year. Net asset value at the end of the year was 116.22p, and I'll talk a bit more about that in a moment. That brings our aggregate shareholder return over time, so i.e. all the dividends paid to shareholders plus the existing ongoing NAV and their holding, to £2.11.29. The return for the year was 8.24%. But what was a particular feature of the year was a significant level of dividends paid at 19.92p. That was made up of an ordinary dividend combined with a 13.5p special dividend. And that special dividend was paid out almost pretty well exclusively due to the successful exit of Egress. Again, I've got a slide on that later. So a really decent return to shareholders by way of special dividend to recognise a substantial return for the fund. But let's dig into the numbers in a bit more detail on the next slide. If we look at performance over time, which I think is important when considering the performance of a venture capital company, it's important to think about it as a long-term investment. And just by way of reminder, our target dividend return is 5% per year. So what this slide is showing is the net return over cumulative over those periods. That's the net return to shareholders on a annual basis. So effectively, that's out of which the dividend is paid. So we're looking for at least 5%. So as you can see on a 5 and 10 year view, that's 10% and 9.5%. We are substantially ahead of our target dividend, which is great. Worth noting that on a 3-year basis, we're a little bit behind, but that reflects a particularly difficult period as the market came out of the pandemic. And we saw some very high valuations being ascribed to technology and healthcare businesses in the latter half of the COVID crisis, which very rapidly unwound. That said, the last year at 8.2% is pleasing, but I do reiterate that's a broader point. We should be thinking very much about the 5 to 10 and particularly the 10-year numbers when appraising performance, because venture capital by its nature is quite volatile and the returns are not always linear. Moving to the next slide. So what happened within this year? Fundraising, as you will all know, we have an annual fundraising to increase the size of the company and to provide capital for our investment activities and other working capital purposes. Fundraising was a little bit higher. That reflected a sort of mixture of things here. One, the company was bigger because the fundraising was post-merger. An important point to note is all those 2024 numbers refer to the fund pre-merger. Exits was, as I alluded to, a particular feature of the year with egress. So total exits of just over 32 million, of which 25.7 million came from egress alone. And then a busy investment period, so 14 million invested in 12 new companies and a number of existing. Share buybacks higher, which I think is unsurprising in a year of a merger. And then the dividends is considerably higher, but that is explained by that special dividend, 13.5p, which in pounds terms is 15 million. But if we move to the next slide and actually look at what delivered investment return in the year, Quantexa, which is our largest investment, features at the top of the table, and that was following a substantial fundraising. It was known as their Series F, when part of the Ontario Teachers' Pension Plan, the big US pension scheme, came in as part of a funding round. That funding round was disclosed at 174 million, and that number, as is customary when disclosing venture rounds, includes both the primary capital that came into Quantexa, i.e. new money into Quantexa, but it also aggregates other secondary purchases that were made at the same time. Egress was pleasing to see, so that is the business that was sold in the year, and that uplift is important because what that reflects is the premium over our carrying value that the final sale price delivered. So from that, it's a useful validation of our approach to valuation, and indeed the board's approach to valuation, which is to ensure that the valuations can be backed up by proceeds in excess of that valuation when sold. Inevitably in a venture capital portfolio, we have those that aren't as successful, and that is to be expected. And I'm afraid Nouveau Air had a particularly difficult time as it particularly tried to build its business in the US. And then within the broader portfolio, which is a reasonable sized portfolio now, you have a number of ups and downs. And if you want to dig into detail of that, there's a table within the annual report which gives a full description of the entire portfolio and the movements on each and every company. So there's lots of detail in there. Let's move to the next slide. Looking at the portfolio, that's sitting at 70 companies in the portfolio, so decent diversification across companies by number, but importantly now employing just over 4,800 people, and those are predominantly UK jobs. And I think this is important because clearly the VCTs are here to create companies in the UK, and as part of that, we consider job creation to be an important validation that the VCTs, which after all do enjoy tax benefits, are delivering value to the broader UK economy through the creation of high value, highly skilled jobs. So the portfolio itself has moved a bit because of Egress. Obviously, Egress was one of our top 3 companies at the point of sale. So we've seen, but as the numbers show, we've the broader objective to be predominantly invested in healthcare software is still very much delivered. And what we are seeing is a continuation of the legacy portfolio, which is now becoming quite historic in terms of assets like our renewable energy and our schools is now a very small part of the portfolio relative to the investment objective around software and healthcare. More on that to come. Next slide, please. So looking at the portfolio in a bit more detail, and this is a slide that the shareholders will be familiar with from previous presentations I've made, and it's how we just keep track of how the portfolio looks in terms of the stage of investment, how mature are the portfolio companies. And again, there has been a bit of a shift here, which is predominantly because Egress, which was one of our larger companies coming out, and hence why you see the allocation to scale up coming down because of that to 77% of the portfolio being represented by companies with revenue of more than 5 million. That's repeated on the other side in terms of number of employees, again for the same reason. But we're still broadly a portfolio that you will be familiar with a allocation a little bit higher than 10%, 12%, a little bit higher than previously in earlier stage. But don't forget that it is the early stage investments that seed the larger investments of the future. Next slide, please. Looking at the top 3 in the portfolio, and again, an important feature of investing in a successful venture capital portfolio, that is that the returns are delivered by the outlier companies, those that grow to be of scale. So the 3 being Quantexa, Pravica, and Aviva, Egress having dropped off this slide, having been sold. So these are substantial businesses now, as you can see, and consequently, in terms of book value, with 82.8 million, that is in aggregate 29.7% of the portfolio. So that's an important feature of your investment in enterprise. But these are businesses that are doing very exciting things. They are making progress, they're growing, and they do represent real opportunity for shareholder value creation in the future. And it's worth observing that the investment by the Ontario Teachers Pension Fund into Quantexa is great validation of the opportunity a very well-known global investor has seen in our largest investment, and a great opportunity to validate the valuation that we've ascribed to that investment. So if we move to the next slide, lots of new investment activity. And very much of our sort of pick themes rather than going through every single company. As I've previously discussed, we now have a desire to build up a deep tech element of the portfolio. So these are companies that are trying to solve some of the world's biggest problems through the use of IP in technology. So just touch on those 2. Iron8 is all around the transformation of the grid to enable better flow of electricity in the more complex environment of balancing renewables with other types of bits. So it's a new type of transformer with a key software overlay to make transmission networks more efficiently. And then Latent is our first foray into the broader area of computer games, and it is using AI to significantly make animation within games cheaper, easier, and more effective. So it's using AI to create animated characters within games in a fraction of the time historically. And what that means is it means that some of the small publishers of computer games are able to compete with some of the very largest. So potentially very game changing for that industry. And then the others within here, Papaya is the world of electric vehicles. Instinct is helping asset managers communicate better with their customers. Trumpet is helping sales teams within software businesses. Open Trade is an interesting one in that it's in the broader crypto asset space. So it's allowing products to be created using crypto assets, particularly stablecoin, to provide yield to those holding it. So a whole new way of holding those assets and generating an ongoing return for the holder of those assets. And Cato finally is a piece of software that is allowing commercial real estate agents and landlords to better manage the workflows around their property portfolios. So lots of really interesting businesses that we have all invested in with a view to put further funds in as they grow. Moving to the next slide, please. Follow-on investing, again, an important part of what we do. You're putting in relatively small amounts initially and then building those investments over time. And Mondra, Transfic, and Mandarin Converter were the larger of the companies that we supported in the year as part of that program of supporting our companies through multiple rounds of funding to help them grow. Next slide, please. Touching on the egress sale, it was in terms of quantum delivered, i.e. proceeds to the funds, it was the largest investment that we at Albion have had. And I suspect it's probably the largest within the VCT sector. It delivered across all the VCTs over 60 million, but this VCT in particular had a higher weighting than some of the other VCTs. So its share of those proceeds at 25.7 million was a significant return, which enabled us to pay out that special dividend, which hopefully you will have received. We invested in 2014 and very much in line with our investment strategy, further invested in 2017 and then in 2018. And that company built rapidly over time and was sold in July to a US software group called Nobi4, delivering just over 7 times return for this fund. And Tony and Neil, the founders of that, did a fantastic job for us over a great many years. And we're very grateful for their hard work and their delivery of a fantastic outcome for you, our shareholders. Moving to the next slide. Quick reminder of our investment strategy, which hasn't changed. It's been very consistent for some time now. It's investing across the stages, seed to Series B. In reality, there is more by investment company numbers. There's more in the earlier stage because that's the area where we have seen greater success in terms of backing businesses like egress would be a good example. But with the flexibility to invest later in Series A and even Series B, we're backing long-term trends. That's not only software as a trend, but the subsectors that we look at, particularly around things like data, digital security being good examples, but also within healthcare, looking at the long-term trend of healthcare becoming more complex, needing to be more efficient, and software providing an excellent way to deliver healthcare more efficiently. We are B2B, business to business focused, so these are businesses that sell to other businesses. We don't invest in consumer-facing businesses, and we do that because we are staying away from the cyclical nature of the consumer spend, which is so tied to the broader economic environment. And as I said in my broader description, the software, healthcare, and now an early exposure to deep tech being key themes in terms of where we are hunting for those exciting companies of the future. Moving to the next slide. Thank you. So prospects, this is a difficult slide for any fund manager at the moment. I mean, I think ongoing uncertainties is a bit of an understatement, but we must balance that uncertainty with the fact that there are some very interesting businesses within our portfolio that are doing great things. So whilst any venture capital returns will not be linear, will move up and down over a period, I think we can look at our portfolio and be pleased with some interesting opportunities, both in terms of the companies that have been in the portfolio for longer, but also for some of those new investments that I described that are joining the portfolio at the bottom end. Mission critical products is really important to our strategy. We want things that we want to be backing products and that companies are going to need for the long term. And one of my colleagues uses the analogy of British Airways was able to turn all its planes off when there was a pandemic, but they couldn't turn off their cybersecurity protection. To repeat, limited exposure to discretionary consumer-facing business services. That is a key feature of our portfolio construct. And I think what is encouraging is that we have a decent level of cash to capitalize on those new opportunities. A little bit more on that in a moment if we turn to the next slide. Cash being the point that we have recently announced further fundraisings across the Albion VCTs, including this fund, which will be raising 20 million with the potential, if the board is so minded, to increase that by 10 million to 30 million. In terms of timing, we're hard at work producing documentation at the moment, where if all goes to plan, we will be launching in October, and it will be open for applications in November. So those that would like to top up their holdings, please keep an eye on that. Everything will be published on the Albion Capital website. And then if we move to the next slide. So we've just announced our Q1 results, which have just gone out on a regulatory news service. NAV a little bit of a small drop for the first quarter, but please do look at these sort of movements very much in the context of these are long-term investments and not reading too much into single quarters. The top three account for 31.1%. That's an important number that I make sure we update you on regularly, because it's an important feature of what is involved in investing. There is inevitable concentration in a portfolio of a venture capital nature. The first dividend of 2.91p you should have had on the 29th of August, and that's based on our target dividend yield of around 5%. We will be again having our physical annual shareholder face-to-face seminar. We think that's important. Our AGMs are held virtually, which is both efficient and easily accessible. But we do like the opportunity, and I know the board in particular like the opportunity to meet shareholders face to face, and it allows me to talk more about the broader Albion portfolio, the Albion business, and then we have various other topics under discussion, from views on the economy right the way through to digging deeper into some of the investment themes that we are investing around. It's on the 18th of November. It will be at number 11 Cavendish Square, which is where we were last year for those that were able to join us. The places inevitably are limited, although we can have a decent number. So please, if you would like to come, and I very much hope you will, please could you send an email to info@albion.capital and reserving yourself a place before we reach capacity. So on that note, I will hand back to Ben. Thank you very much for taking the time to listen to me, and thank you for your ongoing support over the year.
Thanks very much, Will, and hopefully the shareholders found that as illuminating and helpful as I did. Thank you. So moving now on to the Q&A session. We have received some questions in advance of the meeting, and there were a couple of questions which are linked, and I wanted to address first. The questions were around our kind of valuation methodology, and in particular in relation to investments which are loss-making. The reason I wanted to deal with the valuation issue first is, to my mind, and I know that my fellow board members feel the same, it's probably one of the most important things that we consider as a board when we hold the manager to account. We do put enormous effort and scrutiny into the valuations. They're the very essence of the portfolio, and the nature of the investments mean that the valuations do need to be very carefully considered. So we have a robust, multi-layered approach to valuation. There is inherent interrogation and challenge at every stage, culminating in extensive consideration at the audit committee, and indeed when the board ourselves, we all meet with the auditor. We do challenge the valuations, and as a board, we will not rest until the challenges are met and the issues raised suitably reconciled. It is, again, I can't emphasize enough, number one on our list of priorities. We recognize the importance to you as shareholders, and we, again, I can't say more than we look at it at every board meeting, and we have very specific and robust multi-layered formula for approaching the valuation, all of our valuations are conducted on best practice guidelines for our industry. And that then leads me to the next kind of analogous question, which is around the valuation of loss-making portfolio companies. It's obviously inherent in what we do. We invest in early stage, high growth companies. That's our whole raison d'etre, the whole reason we exist. And by definition, many of those companies, a characteristic of them being early stage growth companies, is that they are initially loss making. That's why they need the investment that we provide. So that's why the industry and Albion themselves are so careful on following all of the best practice. And essentially, the loss-making companies are valued on the basis of revenue and growth, as you'd expect, within the confines of what we do and what our portfolio companies do. We're endlessly kicking the tires on that. And in particular, we're looking to make sure that when we get a crystallization event, that crystallization event validates the valuations that we have been working to. Whether it's a particular fundraising event, or in the case of, for instance, Egress, as Will has just run through, where you're carrying something of value for many years, and when it is sold at a level that absolutely justifies that value, that is excellent kind of third-party validation of the processes that we have been overseeing. So to summarize, valuation is the top of our agenda. It is always challenging because we are investing in early stage, high growth companies, which quite often are loss making, but we interrogate and challenge, and we follow best industry practice. And to date, that has been validated in the crystallization events which have supported the methodology. So I hope that's helpful on that. So can we move on, moderator, to the next question? If somebody, yeah, perfect. Okay. So no other questions have been submitted. I think there was one more question.
Ben, we have, shall I, we've got some questions here, which I will read out to you if that's.
Yeah, perfect. That's wonderful.
So the first one is, I firmly believe that there should be a physical AGM, not a virtual one. And I believe that shareholder rights being undermined in this respect. I particularly note the PIRC's guidance on this matter.
Yeah, okay, thank you, Will. So look, I've got a lot of sympathy for that question. In many ways, I would much prefer a real meeting as opposed to a virtual meeting. We've spent a lot of time at the board considering this, and the one thing that doesn't seem to work at the moment from a cost perspective is a hybrid meeting. So the current costings that are coming through for a hybrid meeting make it prohibitively expensive. That could change, and this is, permanently under kind of consideration at the board. A hybrid meeting, I think, could be ideal, but at the moment it would be very, very expensive. So given that cost issue, you're then left with a choice of a physical meeting or this virtual meeting. There are many people who are fans of one or the other, and of course, many critics of one or the other. The advantage of a in-person meeting is you can't beat actually meeting people and spending time with them, and it's a much more natural dialogue. The disadvantage is that for many people, it actually stops them engaging because they'd have to travel to central London, they'd have to take significant times out of their day. So much of our feedback is that we get much greater shareholder engagement through the virtual meeting. And I think the numbers attest to that. So for the moment, we have determined that greater shareholder engagement trumps the advantages that would be there for a physical meeting. The cost of a hybrid meeting is too great, but we will continue to consider that every single year. And if the costs come down of the hybrid meeting, that to me would seem the ideal outcome to best please most of our shareholders. Will, are there other questions?
I think I have a feeling this one you might throw in my direction, I suspect. So the question being asked here is, how are VCTs perceived by the Labour government? Are there opportunities to enhance the scheme?
I think you are very well placed to deal with that one, Will.
No, indeed. Thanks, Ben. So no, absolutely. So this is something I'd spend a decent amount of time on, is sort of working with the various stakeholders in respect to the VCT scheme, and obviously the government and Treasury in particular are a very important stakeholder through the tax benefit that they give to our investors. So in terms of the way one might think about it when looking at current government policy, I would first draw everyone's attention to the fact that one of the first things the Labour government did when they came to power about a year ago was that they completed the extension of the scheme, which was known as the extending the sunset clause, for a further 10 years. So that was hugely helpful because there was a certain amount of uncertainty when you're sitting with a scheme that was due to come to an end in 25. So it was very welcome that one of their early actions was to extend it to 2035. So that gives us good sort of visibility of their views around the scheme and a time period that we are operating within. I think what is also helpful is that we have a government that is very clear that one of its important ambitions is growth, and it is well documented that growth is on their agenda, and they are looking for ways that they can create economic growth. And in that context, we've had some very constructive conversations, both with Treasury and parliamentarians and indeed ministers, about how VCTs can fit into that growth agenda. And there is very much an opportunity to answer this question, in answer to this question, that we can be part of the growth solution that is needed. And in that respect, a way that could be done would be to expand how the scheme operates, and that's specifically around enabling us to be invested in companies for longer. So I've been able to invest more into each companies if they are doing well, both in any one year and over their lifetime, but also looking at areas around the sort of size of company that we can invest in and the age. So there's a sort of package of ideas that we've been working on and have shared with government, and we very much look forward to continuing engagement and indeed look forward to what might or might not be said in the budget at the end of November. So in answer to that, I think we are in an environment where what we do is very much in government policy, and we are very grateful to the support that the scheme has been shown since Labour came into office.
Thanks, Will. Are there any more for either you or me?
No, I'm just checking the online. Nothing has come through whilst we've been doing those previously submitted questions. So I think on that basis, we've probably done our Q&A, Ben.
Okay, thanks, Will. That's great. Okay, well, we'll now move to the formal business of the AGM. The full text of each of the resolutions were set out in the notice of the meeting, and the board is recommending that members vote in favour of all the resolutions, and I'll briefly summarise those resolutions. The first resolution is to receive and adopt the company's accounts for the year ended 31st of March 2025, together with the strategic report and the reports of the directors and auditor. The second resolution is to approve the directors' remuneration report for the year ended 31st of March 2025. The third resolution is the re-election of Christopher Burrows as a director of the company. The fourth resolution is the re-election of Philippa Latham as a director of the company. The fifth resolution is the re-election of Rodri Whitlock as a director of the company. The sixth resolution is my own election as a director of the company. And the seventh resolution is the election of Lord O'Shaughnessy as a director of the company. The eighth resolution is the appointment of Johnston Carmichael LLP as auditor of the company to hold office from conclusion of the meeting to the conclusion of the next meeting at which the accounts are to be laid. And the ninth resolution is to authorise the directors to agree the auditor's remuneration. The 10th resolution is to allow the directors to allot new shares. The 11th resolution is to approve the renewal of the company's dividend reinvestment scheme and provide authority to allot shares under the scheme. The penultimate resolution is a special resolution to give the directors the power to disapply preemption rights. The final resolution, which again is a special resolution, is to authorise the company to make one or more market purchases of ordinary shares in the capital of the company. The results of the voting, including the proxy votes on each of the resolutions, will be announced after the AGM through a regulatory information service announcement. Additionally, the results will be published on Albion Capital's website as soon as reasonably practicable. I confirm that the voting is now finished, and I now declare the poll closed. In the meantime, I will show on the screen the current proxy votes that have been received by the registrar. As you will note, the proxy votes are comfortably in favour of the proposed resolutions. Thank you very much for attending this AGM, and that concludes the business of the AGM. I would like to thank all members who have joined this AGM. The board welcomes any feedback you may have, which you can do by sending an email to me at aaevchair@albion.capital. I will now formally close the AGM, and on behalf of the board, thank you for joining this meeting. I declare the meeting closed.